Good morning, everybody. I'm placing an order short euro at 118.82. So order placed, sell short at 118.80. I'm moving down order to 118.81.5. All right, so order placed. Welcome to SG Trader. Just short sum up, I wanted to tell you what you can see for our new subscribers on the screen. We show you 5 pairs. We show you Japanese yen, British pound, Canadian dollar, euro, and Bitcoin. We trade live our own funds and our clients' funds. So all orders, all positions, it's not from demo account, it's from our live account. You can follow our trades, you can copy our trades, it's free. You can use your own broker. If you need help to open an account or something like this, please let us know. Every pip will, 1 pip will cost £100, except Bitcoin, where 1 pip equals £10. All right.
The possibility of that happening is just the fact they want to have that flexibility. They don't want to kind of put a floor under the policy rate right now, and that's because that could, create this this tightening in financial conditions, which clearly they want to avoid. So there was a statement within the MPR this morning that actually said that negative rates are unlikely to be as effective as a policy tool this time around, but it's very conditional because they are saying that if needed, they could actually embark into negative. So it's something that still remains on the table.
As we get closer and closer to erasing losses for the year in U.S. stocks, at least, and nights I sit on my porch thinking about how old I'm getting, considering just going all into govies, right? Because I don't want any risk. I saw your column this morning. Normally that's depressing because, you get no yield, but I saw your column this morning, your macro movers piece, and I thought, man, if there really is, just an open trap door beneath real yields, maybe I make something on capital gains with bonds. What do you think about that?
Well, I think certainly, just given the current circumstances, we're likely to see real yields tumble even further, and they're already at record lows in the U.S. Just because when we look at kind of what are the drivers of this right now, so economic angst continues to see this bid for safety, so that continues to drive it higher. We are seeing these monetary policy pauses coming from the Fed, with rates unlikely to rise for the foreseeable future. And then when we overlay that with the current conditions where inflation expectations are climbing back to those kind of 2% levels, clearly then the real
Order to sell short cancelled. It moved too far. Let's see what's going to happen for a few minutes. So order to sell short euro was cancelled.
that abounds. So really at this stage, I do still think we're going to see this piling in to kind of the fixed income market, yes.
Laura, we had the U.S. stocks rally yesterday on stimulus talks. Today, we're seeing a little bit of gloom and doom across European equities. But my question for you is, how much could the fiscal stimulus really boost equities? Because if you look at the data yesterday out of the U.S., it was pretty much mixed. ISM was strong, but those ADP figures were pretty weak. How do you have a recovery with a weak labor market?
Well, Well, I think that's the issue, is really just that stocks are continuing to price in this optimism that an eventual stimulus deal will occur, and that kind of negates all of this potential negative, weakness that we're seeing come through in the data. I think crucially, the initial jobless claims today will provide a further indication that yes, we are seeing a stumbling jobs recovery, and that's really not yet priced into markets. When we look at more high frequency indicators, that is pointing to, a potentially less of a rebound going forward. And if we don't see these expanded benefits be put back into place, then clearly that's going to be a clear risk to the consumer spending rebound that has actually proved quite resilient through the second quarter. And I think at this stage, markets are not yet kind of attuned to that, because it's all based on just these whiffs of stimulus hopes.
Anne-Marie, I thought you were going to do some kind of incredibly intricate gold-oil ratio question. What's with the ratio that you've noticed? Seriously. No, you were pointing something out this morning about how this ratio has reached new levels.
Well, everyone's talking about gold is very expensive, but when you look at the gold-oil ratio, it's actually not that pricey. Laura, what do you make of that?
Well, that is interesting, and actually I did notice that this morning. Gold oil is at a record low ratio, and I think really at this stage it's all about, gold is in the eye of the beholder, so whatever metric you determine to value it. But I think kind of just taking a step back, when we look at considering the tumble in real yields, considering the dollar weakness, considering that market inflation bets are kind of ramping higher, clearly the rally does seem reasonable. Yes, gold is expensive, but it's hard to see kind of what will halt the momentum going forward, just given this environment where we're in of just this exceptional stimulus and heightened uncertainty.
All right, Laura, thanks very much for joining us. Bloomberg MLive's Laura Cooper, macro strategist out of London, talking to us about a number of things going on in the market. I want to point out, Danny Berger just messaged us also and pointed out stocks also don't look that expensive when priced in gold. And clearly, when you see gold rising to a record like that, nothing looks that expensive if it's priced in those terms. And I think it's a really interesting way to look at the market.
I'm placing an order to buy Japanese yen at 105.505. So order placed to buy yen for 105.505. Today it's moving really fast, yeah? I probably will have to cancel again. Let's see what's going to happen with this candlestick. If it will go down, I will get executed. It will be executed. If not, I will have to cancel. Looks like we'll take my order. Let's see. Come on. And what? It will bounce back. Okay. Position open for Japanese yen at 105.505.
Good morning. Welcome back to the European Open. We're 10 minutes in today's trading session, and what you're seeing on the screen is a big leg lower in terms of FTSE 100. European equities mostly on the back foot. Slew of earnings to address. On top of that, we have those stimulus talks, the U.S. really facing a deadlock. Now let's get the Bloomberg Business Flash. Here's Laura Wright. Laura?
Thanks, Anne-Marie. ING has seen provisions for bad loans surge, the Dutch lender putting aside over 1.3 billion euros to cover the expected defaults. Net income at the bank slumped 79%. It's a similar story across much of the industry, with banks being hit by the unprecedented impact of the coronavirus. Europe's largest engineering company has dealt with the coronavirus better than expected. Profit at Siemens rose 8% in its fiscal third quarter. Earnings were bolstered by cost savings and a recovery in China. A big jump in profit as its software business also offset declines in other areas. Samsung has set out its premium Android device lineup for the rest of the year. It's launching the Galaxy Note 20 series, but it's not just the smartphone. It's echoing Apple by focusing on an ecosystem for its products, including a smartwatch and wireless earbuds. Samsung lost the crown of the world's biggest smartphone maker in the second quarter, and it's hoping the new products reignite some interest. That's your Bloomberg Business Flash. Anne-Marie, Matt.
All right, Laura, thanks very much. Laura right there in London with the Business Flash. Now, I promised we'd talk about Germany's Merck, and we will. The company has raised its earnings outlook for the year. That's as Merck says the coronavirus pandemic will probably abate in the second half, resulting in local flare-ups, but no widespread lockdowns. Merck's life sciences unit has also partnered with vaccine developers from the University of Oxford in the UK to Baylor College of Medicine in Texas in their bids to speed up their research for coronavirus into coronavirus immunizations, and of course already has products like remdesivir that are working here. Joining us to talk more is the Chief Financial Officer at Merck, Marcus Kunert. Marcus, thanks very much for your time. Let me talk first about your numbers and what the market sees in your results. Right now, we're looking at shares that are actually off a little bit, and I wonder why, because when I look at the headlines, it seems you beat and raised.
Yes. So obviously, as part of the management, I'm not supposed to comment on our share price development. So I think that obviously we have seen, unsurprisingly, a mixed second quarter. However, also on the other hand, ahead of our own expectations. That means that the reason for the slight margin upgrade that you have seen is that first of all, the COVID-19 impact on our numbers in the second quarter was not as severe as we would have anticipated in May. And secondly, and that is a very positive note, when we look a little bit further into the second quarter and if we assess the performance month by month, we have seen two pretty bad months, April and May, but we have seen at the same time a significant recovery in June, and that gives us a lot of confidence that the expected recovery for the third and fourth quarter of the year will actually happen, and that has also led us to raise slightly the lower end of the EBITDA guidance for 2020.
Marcus, you sound quite optimistic about the recovery of COVID-19. You're also working with Oxford in the United Kingdom as well as Baylor College in the United States. How soon could we see these vaccines that you're helping to work with to these two universities? How soon can we see those vaccines come to market?
That's a good question, actually. And if I had a crystal ball, I would feel more confident to give you an answer now. All I can say is that, so indeed, we have, I would say, a broad coverage of activities where we are supporting the UK Jenner Institute, as you rightly mentioned. We are also working in a consortium with other pharma companies and the Bill and Melinda Gates Foundation to accelerate the development of vaccines and so on and so forth. There is good progress. However, I think that it will take at least another 9 to 12, maybe even 15 months, so well into 2021 before we might have a vaccine that also works.
what do you think about the possibility of revenue? I mean, right now everyone's being very altruistic about it, talking about, giving vaccines for cost or for free, and clearly this is a tragic pandemic, but at the end of the day, you spend money on R&D in order to make drugs and sell them for profit. So what does the possibility of revenue look like connected to this coronavirus?
Of course, there are also, let's say, economic opportunities associated to that. When we look on this a little bit more in detail, it is very clear to say that in general, for us as a pharma company, vaccines are generally less attractive from a value perspective compared to, for example, therapies, as we generally sell less of our portfolio, much less into vaccines compared to therapies. And also when we look on the different kinds and ways on how to vaccinate, also there are differences. So for example, the so-called messenger RNA vaccines is from the value perspective for us the least attractive, as this approach does not have an upstream part. Yeah? Instead, it is basically based on chemical synthesis and only requires relatively small portions of our downstream offerings. On the other hand, the most attractive would be a viral vector or recombinant DNA vaccine, as we would be selling various up and downstream components from our portfolio. And for example, our mentioned collaboration with the Jenner Institute is exactly going in that direction.
Another big topic in the news, of course, has been diversity, Marcus. Companies are really starting to look internally at their structure, even individuals within themselves. What are you doing on this front? You recently named a deputy CEO who is a woman, but what sort of conversations are you having to elevate women and also minorities to more senior positions at your company?
Yeah, so let me tell you that diversity plays a very important role in our company, not only very recently, but also since quite a while. And so, for example, just to give you an example, the topic of gender diversity and bringing women into senior leadership positions at Merck is already now the second year in a row a key performance indicator in our company scorecard for all of our employees. So everybody has, let's say, as part of his or her incentivization.
I am placing stop on profit for Japanese yen at 105,525. So stop on profit placed at 105,525.
For actually moving the share price in the right direction, that means up. But it is not on us to judge whether this, I would say, endeavor or effort was finally successful enough. That is your job.
Marcus, thanks for joining us. Speaking of the share price, it's down nearly 0.8% this morning. Marcus Kernert, CFO at Merck. Now, coming up, engineering giant Siemens defies expectations, reporting a boost in profits despite the pandemic. We'll hear from our interview with CEO Joe Kaeser. That's coming up next. This is Bloomberg.
Position closed. So Japanese yen at 105,525. Profit £200.
Welcome back to Bloomberg Markets. This is the European Open. We are 22 minutes into the trading day right now. We're looking at kind of a mixed picture here with the DAX rising almost 0.5% and the FTSE falling 0.9%. Siemens shares are climbing this morning. That's after operating profit in the third quarter beat the street's estimates. Since taking the helm in 2013, the CEO, Joe Kaeser, has dismantled large parts of what once was one of Europe's largest conglomerates through IPOs, spin-offs, and sales. He confirmed to us today that he's now looking at options for the Flender unit.
We have decided that we are going to, or that we are planning to spin off Flender, which is a very reputable company with its own strong brand. This is going to be presented at the AGM in 2021 for shareholder approval. We believe it's the right thing to do. We also always want to obviously include our shareholders in the value creation, which we believe has been tremendous also at Flender, and that's the plan.
Good morning. Thanks so much for joining us. Can you just dive a little bit deeper into that? You're going to announce this. What's the evaluation of it? And would you consider a cash bid from private equity? Just give us a little bit more details.
Well, with regard to Flender, we basically restructured the company. It's well underway now, takes good growth rates in very attractive growth markets, such as renewable energy. It's one of the world market leaders in gears. So it's a very strong company, and we have a plan. And our plan is that we are going to return the proceeds to shareholders via spin-off. We want to have that approved at our AGM 21, and whoever believes that they've got a better idea for the customers, the employees, and the shareholders, be happy to listen.
Joe, you are on your way out, and there have been reports that Roland Busch is going to take your job as CEO in October rather than in February, as previously had been planned. Can you also confirm that this transition is going to happen sooner at Siemens?
Well, we've always made it clear that we do want to have a very smooth, long-term oriented transition. So Roland Busch will take over the responsibility for fiscal 2021 already in October 1st. I think that's only logical, because then he's got the responsibility and the accountability for a whole fiscal year. That's been a long-term plan, which we actually have been announcing already sort of 6 months ago. We've made a very long succession plan. He's the right guy. He's really, really strong, good manager. So I'm very happy to see that he's taking the responsibilities and bring the company to the next level. We believe we have prepared the company well for the next level in doing what we had to do. And now, there's a new generation, which we announced yesterday, also with new people on the managing board. And I'm very happy what I see.
Joe Kaeser, CEO of Siemens, speaking to us earlier, talking about a new generation at the helm of the company. Now, we're 26 minutes into today's European trading session. Let's take a look at some of the corporate movers. Adidas, as Matt would correct me, climbing as a surge in e-commerce really helps boost their sales. The lockdowns lifted, and that led to store closures, but now they are seeing some of those sales. They're up 2.6%. Lufthansa also higher this morning. Europe's biggest airline toughened its tone on job cuts as it braces for years of reduced demand. And then Glencore to the downside, actually one of the biggest losers this morning on the benchmark index, scrapped its dividend for the year, Matt. So that's definitely weighing on the stock this morning.
When we were a kid, Adidas, we all had the shirts when I was a kid, and we would say it stood for all day I dream about sports. Coming up, skewed to the downside, the Bank of England says it won't tighten until inflation moves to sustainable targets. Welcome back to Bloomberg Markets. This is the European Open. We are now 30 minutes into the trading day and seeing an interestingly mixed market here. You've got gains across, in the DAX and losses on the FTSE. And if you take a look at the benchmark European index, the broader benchmark, the Stock 600, you can see that we're actually just treading water here, just up about 0.04% due to that mix. Take a look at the GRR, the group ranked returns, to see what's up and what's down across Europe. And you'll see industrial goods and services are gaining. That's really the Siemens beat. And Siemens is a very heavy weight. It's what's helping the DAX gain. And its lack of, well, the fact that it's not listed on the FTSE is why you see London down. That and the fact that basic resources are the big losers here, and Rio Tinto is one of the biggest losers on the Stock 600. That's, of course, listed in London, so the FTSE is falling with really more stocks. Rio Tinto is down, Unilever is down, Diageo is down, Glencore is down, BP is down. These are the ones that are hurting the FTSE. But on the DAX, you see gains in Siemens, in SAP, in Adidas, as we were just talking about. So that's why you see the German benchmark rising as well. Very interesting market today. Let's get the first word news. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Researchers are developing a coronavirus vaccine as fast as they can, but that doesn't mean it's going to be 100% effective. Infectious disease expert Anthony Fauci says that a potential for a vaccine to be 70% effective is in sight, but he says he'd still feel good if it's at least 50% effective.
The classical history of viruses, particularly respiratory viruses, are such that if they are going to be something that is as capable as this virus is of efficiently spreading from human to human, ultimately, if you really want to put the nail in the coffin of an outbreak, you're going to need a vaccine.
President Donald Trump wants an earlier debate with presidential candidate Joe Biden. They've got 3 presidential debates planned already, but the Trump campaign is calling for one to be moved forward or a 4th added. They're hoping for a clash between the 2 candidates before the early mail-in voting starts in September. And the chemicals suspected of causing that deadly explosion in Beirut had been lying in storage for 6 years. That's according to documents seen by Bloomberg. And despite warnings from customs officials about the hazards, ammonium nitrate can be used to make fertilizers and explosives. And the amount in that building was said to be the equivalent of about 1,800 tons of TNT. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anne-Marie, Matt.
Laura Wright in London, thanks so much for that. Now, as we've been saying throughout the past hour and a half, we did have this rate decision out of the BOE. A lot of it unexpected. There's really no surprises in terms of the top line, but if you did dig a bit deeper, what they've said is some interesting moves. April LaRouche joins us now, Inside Investment Fixed Income Investment Specialist. April, thanks so much for joining us. I know me and Matt have a bit of a mixed picture. He thought it was a very interesting report. I was a little bit more unsurprised, but they did give this review into negative rates. They highlighted the drawbacks. Do you think that this means that they're trying to, signal to the market that they don't want to go there just yet?
Yeah, they're absolutely signaling to the market. Frankly, they realize, as we all do, that negative interest rates can actually be really damaging to the financial system. They finally got the banks healthy. One thing they don't want to do is undermine their profitability. And the degree to which negative interest rates would be passed through to the underlying borrowers is also debatable. But they did actually talk at length in the report about it, and that it is a policy tool available to them. But actually, we at Insight don't expect them to use that. And we think interest rates will ultimately stay positive, but just positive.
Yeah, I'll tell you what, as a consumer borrower, I haven't found any negative rates being passed through yet. I guess if you're a Danish home buyer, maybe there's a chance, but otherwise, it seems that it seems that much of the world has already made a judgment on the damage done by negative rates, and only those central banks that have already gone there are still defending them. I thought this was still an interesting report, though, April, because a lot of little tidbits I found fascinating. For example, the Bank of England saying that credit losses may now be better than expected. That's kind of like a ray of sunshine coming in through the clouds, because I've been prepared for this horror show of a Q3 when we start to see cascading bankruptcies, as Joe Stiglitz has predicted. Is that going to be avoided, at least in the UK?
Yeah, well, it's nice to hear a slightly more optimistic tone from the bank in their report, but we do think that it's a little premature. I mean, there have been many different programs put in place to obviously support companies, and that's really, helpful. But as that support starts to be removed, and as the true impact on, how consumers behave going forward, how businesses behave going forward, I think then we'll start to see the true evidence of what's happening to businesses. So I think the jury's still out, but obviously the Bank of England wants to sound more optimistic looking into the future.
April, I was also interested a little bit of the tidbit of unemployment. They say it's going to rise about 7.5% to the year end. Of course, the government right now is supporting that, but October, a lot of that support will be stripped away. Similar to what we're seeing in the United States as well. It's where the joblessness comes in, is where you see this potential weakness to the recovery. How do you have a recovery without a strong labor market?
Yeah, and that is going to be the really tricky thing, because when you're looking at the different surveys, what you see is that not a very large proportion of businesses surveyed say they are intending on re-employing people who are currently on furlough. I mean, some businesses, frankly, will just have the wrong business model or just have too much staff for what the new economy looks like in a COVID world. So really the delicate balance will be to make sure that they don't take away these helpful job retention schemes too quickly. As it is, they will end in October, or the majority of them. Of course, there's a possibility of extension, which may indeed happen, but unemployment can take a very long time to come down. If you think back to 2008, it took almost 7 years to get unemployment back down to what we would consider a more palatable, normal level of around 5. So really, they're trying to stop it ever going up, because they know it can take a very long time to come down.
They say they won't tighten until inflation sustainably moves to target. That was I think the first big red sticky headline that we saw in the Bloomberg today. At the same time, April, I get a lot of email from viewers who say, all the stuff I need to buy, like milk and bread and bacon, is just skyrocketing in price. Meanwhile, my fixed income investments aren't giving me any return. And today, the MLive blog had a story about real yields just falling through the floor with no bottom in sight. What do you think the outlook is for inflation and for real yields?
Well, certainly for inflation in the near term, it's going to go lower. Obviously, energy prices are very low, and that's coming through. And of course, the VAT cut on the hospitality sector is also something else, which is impacting inflation in the near term. Actually, the bank is saying it's going to take certainly over a year to get inflation back to target. And it's hard to imagine a scenario where the monetary stimulus creates an inflation issue, because we just have so many other disinflationary forces. In terms of real yields, clearly the markets are thinking that, what is the normal level of growth going forward? And is that potential economic capacity or growth level actually lower than it was previously? And so we just continue to see real yields decline. Yeah, and it's a challenge for investors. Investors looking at where are they going to get yields without having to be forced effectively into investing in riskier assets, which maybe they're not comfortable with.
But that is, of course, the kind of financial repression that central banks have put into action. April, thank you so much for joining us. I hope we can get you back on again soon. April LaRousse is Insight Investment Fixed Income Specialist, joining us here on Bloomberg Television. Coming up, Jerome Grivet, the CFO for Credit Agricole, joins us for an exclusive interview. We'll talk earnings and loan loss provisions after the bank set aside more than expected to cover bad loans in the face of the COVID pandemic. This is Bloomberg.
Welcome back to the Open. We're 42 minutes into today's trading session. FTSE 100 down 0.6%, but the DAX and the CAC 40 are pushing higher this morning. And we've had a number of earnings, including Crédit Agricole. They set aside more than expected to cover bad loans in the second quarter. Provisions jumped to 842 million euros after the COVID pandemic hit the French lenders' big clients. Now, joining us now for an exclusive interview is Jérôme Grivet. He's the CFO of Crédit Agricole. Jérôme, good morning, and thanks so much for joining us. I want to start with those provisions. You set aside more than expected. Will this be enough?
Well, good morning to everyone. We've put aside a significant amount of loan loss provisions, but half of the increase as compared to Q2 19 is due to what I could call prudential provision, i.e. provision covering sound performing loans. So actually it's a very prudent approach that we have had on this provisioning effort, and this provisioning effort was made possible by a very robust operational performance.
We were just talking, Jérôme, about the Bank of England's outlook for the UK economy. They said, unfortunately, they see unemployment rising materially through the end of the year. On the other hand, the Bank of England expects credit losses in the UK to be a little bit better than they expected in May. What's your outlook on the French economy, especially in terms of credit losses and unemployment?
Well, the French economy is rebounding very, very rapidly, very sharply after the lockdown period. And actually, all indicators that we see across the French economy since the middle of June are positively, very positively oriented. And we find exactly the same evolution when it comes to our own activity indicators. All our activity indicators are sharply up in June as compared to May. and this continues across July up to now. So we are reasonably optimistic about the possibility for the French economy to really overcome this lockdown period and to find back a more normal pace of activity.
Speaking of the French economy, what about your outlook on retail activity in France and abroad? Given this lower for longer interest rate environment, what are you seeing and what are you expecting for the rest of the year?
Well, it's true that one of the outcome of this crisis is that we are going to have negative or nil interest rates for a longer period of time than what we had initially expected. But within Crédit Agricole SA, the listed vehicle of the group, actually only 1/3 of our revenues come from net interest margin. So it means that we have the capacity actually to generate revenues with fees, commission, insurance revenues, trading revenues. And so this is providing a very good resilience to our capacity to generate revenues and profitability. So this is really a key element of our robustness. Besides that, what we are seeing, as I said earlier, is that all activity indicators within our retail networks, it's the case in France, it's the case in Italy, it's the case across Europe for all our consumer credit businesses, there is a very sharp rebound in activity in June and further in July.
You know, I often look at share performance on a 5-year chart, Jerome, and I'm looking at your shares over the last 5 years. You outperform local rivals BNP Paribas and Soc Gen, but banks in general have done a lot worse than the broader benchmark CAC 40 index. Do you think that it's time for that to turn around right now, or are there restrictions that you have been given, for example, the ECB recommending still no dividend payout through year end? Are those kind of restrictions holding banks back?
Well, it's true that banks have been underperforming the rest of the market in the last period of time. I think that many reasons can explain this underperformance. When it comes to our stock and when it comes to our performances, what I can say is that last year we've managed to generate a return on tangible equity for the listed vehicle of the group, which was close to 12%. For the first half of this year, we are at 8.5%, and you know that the first half of the year is earmarked with a significant amount of taxes and contribution to the Single Resolution Fund. So it means that actually on an annualized basis, we would be already close to 10% of return on tangible equity. We have a good visibility on our capacity to continue to generate that type of profitability going forward in the present circumstances. So it means that actually we are offering to our shareholders a good visibility and a good level of profitability. Then, of course, there is the more global issue of the outlook of the European economy, the Eurozone monetary policy, and all the regulatory constraints that we have to withstand. But nevertheless, in this space, I think that Crédit Agricole is really a listed vehicle that is attractive, that should be attractive to shareholders and minority shareholders.
Attractive today, you're up 1 7/10%, but why would a shareholder want to buy your stock if you're not giving dividends? Will the dividend return in 2021?
Well, we are going to see what is going to be the policy of the ECB. But what I can tell you is that first, we are accruing a dividend on 2020 results, and actually we have already accrued 24, I think, cents a share end of June for a potential dividend to be paid in 2021. And our solvency, which stands for the listed vehicle at 12% end of June, is far above our targets, considering the fact that we belong to a bigger group which has a much higher solvency at 16.1%. So we perfectly have the capacity to continue with our normal dividend policy, which is to pay to our shareholders 50% of the results that we generate.
Jerome, thanks very much for your time this morning on such a busy day. Jerome Grivet is the Chief Financial Officer of Crédit Agricole, joining us after earnings. Now we want to get back to the Bloomberg Business Flash. For that, we go to Laura Wright in London. Laura? No, in fact, we will bring you Laura later, I promise. Right now, we're going to take a break. When we come back, pressing for concessions, stimulus talks in the U.S. hit an impasse, and the White House and Democrats are still far apart on major issues, like a couple $1 trillion apart. We'll bring you all the details next. This is Bloomberg.
Welcome back to the European Open. We're 53 minutes into today's trading session. Bit of a mixed picture. FTSE 100 down nearly 0.8%, but the DAX in Frankfurt up more than 0.6%. A slew of earnings coming out of Germany, Adidas, as well as Siemens, which is gaining right now, up more than 3.5%. That's probably helping out the DAX this morning. Now, switching gears, the U.S. needs to improve on efforts to test for the coronavirus. That's according to Dr. Anthony Fauci. He's the director of the National Institute of Allergy and Infectious Diseases. He spoke to Bloomberg's David Weston.
The various independent companies that make it and distribute it, and that's just the system, the way it works. I'm not sure. We do have public health groups that get testing from the public health system, but the ones that really drive it are the private enterprise.
And is that effective? Is that the way we're going to beat this thing, as you say, over the long time?
I mean, obviously we need to do better because, I mean, even though we are much, much better off now than we were in the beginning where we had some missteps, at the end of the day, when you make phone calls and you hear that it's taking X number of days to get back, it clearly means we need to do better.
That was Dr. Anthony Fauci, director of the National Institute of Allergy and Infectious Diseases. We're going to be hearing more from that interview on Bloomberg Television all morning. And as Anne-Marie says, it was a very wide-ranging and fascinating interview from David Weston. So definitely keep watching for more of that. Now, Democrats and Republicans are far apart. The Dems demanding more Republican concessions to secure a deal on pandemic relief. But with a Friday deadline looming, both parties are running out of the time that they've given themselves. For more, Jody Schneider, Bloomberg's senior international editor, joins us. So what are the biggest sticking points here, Jody?
Well, it's really about the money, as it always is in these kinds of things. The White House has offered $400 a week in supplemental unemployment benefits, and it had been $600. This is what is expiring. That would be through December 14th, which seems like it's an okay date for the Democrats, but they want that $600 a week. This is for everybody getting these unemployment benefits, and of course, in some cases, people are getting more money in unemployment benefits than they would be earning, but the Democrats are insisting on that amount. The White House has also put $200 billion in state and local aid, including more than $100 billion in education funding on the table, but the Democrats want $1 trillion. The other thing that is a kind of a sweetener from both sides is the White House agreeing on extending the moratorium on evictions through mid-December. So it really is about the money at this point, how much aid is going to be available.
Jody, we'll have to leave it there, and we'll have you back. Hopefully, we'll see if we get a deal by the end of the week. Jody Schneider, Bloomberg Senior International Editor. That's it for the European Open. Stay with Bloomberg Television. Up next, it's Surveillance. This is Bloomberg, live from London.
The BOE holds steady. We'll be speaking with the governor, Andrew Bailey, later today as the central bank says GDP won't recover to its pre-COVID level until the end of 2021. Pressing for concessions, stimulus talks in the U.S. hit an impasse with the White House and Democrats still far apart on major issues. President Trump says he can take unilateral action. Plus, Siemens' earnings climb while Europe's largest engineering company's results came in better than expected as the chief executive, Joe Kaiser, confirms he's looking at options for its Flender unit. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, there is quite a lot going on with the markets simply because the stimulus, of course, in the U.S. is getting some people quite excited. So part of it is that. Part of it is also what we're hearing from central banks around the world with new projections. So this is what the markets are doing overall. So stocks are turning higher. Gold, at the same time, continuing in its ascent. We also have some U.S. jobs data and then the word on the latest American stimulus package. What else I'm looking at is the dollar index trading near a 2-year low. And of course, we need to mention pound rising against the euro after the Bank of England said it did not plan to tighten policy until the inflation outlook was more clear. Now let's get straight to the Bloomberg. First Word News here in London with me is Laura Wright. Hi, Laura.
Thanks, Francine. Researchers are developing a coronavirus vaccine as fast as they can, but that does not mean safety is being sacrificed. That's according to the US government's top infectious disease expert, Anthony Fauci. He hopes a potential vaccine is at least 70% effective, but says he'd still feel good about it if it's at least 50% effective.
The classical history of viruses, particularly respiratory viruses, are such that if they are going to be something that is as capable as this virus is of efficiently spreading from human to human, ultimately, if you really want to put the nail in the coffin of an outbreak, you're going to need a vaccine.
Twitter and Facebook have both blocked a video shared by accounts linked to US President Donald Trump. They say it broke the rules on coronavirus misinformation. His re-election campaign was briefly barred from sending tweets because it posted a clip of the president saying children were virtually immune from the coronavirus. The same video was removed from President Trump's Facebook page. And the chemicals suspected of causing that deadly explosion in Beirut had been lying in storage there for 6 years. That's according to documents seen by Bloomberg, and despite warnings from customs officials about the hazards. Ammonium nitrate can be used to make fertilizers and explosives, and the amount in the building was said to be the equivalent of about 1,800 tons of TNT. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, the Bank of England says UK GDP won't recover to its pre-COVID level until the end of 2021. The forecast came as policymakers voted unanimously to keep the asset purchase target at £745 billion and hold rates at a record low 0.1%. The BOE says a risk to the outlook is skewed to the downside, with inflation likely to fall further below 2% target, averaging around 0.25% in the latter part of the year. Well, joining us now is John Bolton. He's head of global multi-asset strategy at JP Morgan Asset Management. John, thank you for being with us. We're also speaking to Governor Bailey shortly. If you had one question for him, is it the fact that actually forecasts are going on the up, but they also seem at pain to try and give the message to the market that they're not tightening anytime soon? So how do you square up the two?
Well, I think that with anything, I think that the Bank of England have done exactly what you would expect them to do at this time, which is maintain a degree of optionality. You remember, setting interest rate policy, setting monetary policy is a perfect exercise in learning by doing. You have to take information in real time, but at the same time, you're looking to balance risks. I think that some good news came out today, which was the fact that we are seeing consumption patterns coming up a little bit. We are seeing still some positivity around the strength of the rebound. Of course, there are issues such as the unemployment rate, which will continue to be a drag on the UK economy. But I think what Andrew Bailey has rightly done is recognise that there are still risks here. We don't know whether we will get a second wave. We don't know at what point a vaccine might arrive. And of course, we've got Brexit still looming. And ruling out any part of their arsenal would be inappropriate from the point of view of a central banker who needs as many tools to manage the economy and manage monetary policy at their fingertips as possible. And I think against that, one of the reasons why the central bank have perhaps demurred on really indicating that they would use negative real rates at the moment is because of the uncertainty it presents to the banks. And of course, in an economy which is heavily reliant on the financial sector, negative rates are not something which would be necessarily widely welcomed by those who are watching banks for a recovery in earnings.
But John, what do you think it would take them to go into negative rates?
Well, I mean, I think they've been relatively clear about what the key risks they see are. And those two key risks, of course, number one would be a second wave coming through the autumn that resulted in more widespread shutdowns and economic disruption. Again, spilling through into the broader economy via the unemployment rate, via household consumption, of course, staying the hand of any rebound we might expect in corporate confidence and corporate investment. But then, of course, there's still that uncertainty around Brexit and what shape a deal may take by the end of the year. And were we to end up in a situation where a deal was unachievable, then I think the Bank of England have generally been pretty clear throughout that that could be a negative shock in the near term for the UK, and as a result, that might require some policy support from the Bank of England.
John, what do you take on pound? What does it mean actually for UK assets? First of all, if we have a no-deal Brexit and a second wave and a possible second lockdown, is this a perfect storm for the UK?
Well, it's one of those things. And the currency in the UK, as we know, does have a habit of being the lightning rod. We've seen that time after time. Immediately after the 2016 vote, of course, the pound came under remarkable pressure. And it's really followed the ebb and flow of the Brexit debate ever since. One of the issues I think that we've got to recognise is that the pound has strengthened some in recent weeks. But it's very important to recognise that in large part that's a dollar weakening move. And it's as much about some of the broader trajectory of trade-weighted dollar as it is around the pound. In our view, if we get some relatively narrow deal or something which allows a platform for it to be built upon, then we could see further upside to sterling. But make no mistake, if we see weakness in the UK economy, if we see a no-deal Brexit, we would think that there's certainly scope for the pound to fall. It feels relatively evenly balanced as things stand at the moment, and we wouldn't expect to see a big move in either direction near term, but certainly the idea that we take another look at the mid to low 120s kind of range in the event of a no deal scenario, that's certainly something that we have to be mindful of.
John, so where do you see value in UK assets, if any?
Well, the UK's in a difficult spot at the moment, and I think about this in a global context. Let's look at, for instance, the UK index. I mean, it's inexpensive on price-earnings ratios compared to its peers, but it's not really cheap enough to say that it's a value buy at the moment. The UK relies upon dividends. It's a very high-income market by and large, but we've recently seen a number of dividends trimmed, and there's certainly some talk of political pressure on maintaining dividends at a lower level, perhaps even being forestalled for a period of time while we work through this particular crisis. And so I think at the moment, if we look at the sector mix, the financials with the threat of negative real rates in the event of a poor Brexit outcome or a second wave of the virus, significant energy sector, and pressure on the dividend. And the UK market, frankly, it's difficult to see it as being something which is going to get a near-term boost. We would find value actually outside the UK. So we would rather, in a global context, perhaps be a little bit underweight the UK, leaning more into the US, Eurozone and emerging markets at this time. That said, it's worth bearing in mind for much longer term investors, things do tend to right themselves, and there is an inexpensive access to what will be probably a recovering dividend over a number of years. So a lot of it depends how deep one's pockets are, because the UK probably has more bad news to come before we start to see a path to being able to see upside to UK equities here in relative to other asset markets.
John, what would it take for you to change your mind actually on UK assets? So does Brexit need to be dealt with, or do we just need to find a vaccine? Is there something else? If, for example, the government just did more in terms of a fiscal policy, would it make you more likely to buy UK assets?
Well, I think fiscal is an important point here, but it's the deployment of fiscal which is incredibly important. Remember, the UK market, particularly if we look at the stock market, is it's a relatively international market. So some certainty on the outlook for sterling, even if it does mean sterling strengthening a bit because of a dropping in uncertainty, potentially could be good news. But the issue that faces the UK is in a broad-based global recovery, you would expect UK equities to go up with everything else. But the trouble is the UK is still a relatively defensive market. And in a defensive market, you're going to see better performance from more global cyclical markets such as Eurozone, Japan, emerging markets. So for choice, even if we got a rising global economic tide lifting all boats, it may even be then that the UK doesn't perform as well. I think what we need to see is a little bit more dynamism, a little bit more recovery on the UK domestic outlook. So a bit of consumer confidence, perhaps a little bit more targeted fiscal stimulus, which ultimately accrues to the UK economy directly in a way that actually boosts both corporate and consumer confidence. And in doing that, we could see something of a resurgence. But here and now, it really is, in many scenarios, a tough spot for the UK market because of the sector mix and because of the somewhat defensive nature of the market. It's not that the UK market itself necessarily can't go up. It's just that globally, the UK's peers may actually be in a more favourable position from a sector and a cyclical gearing perspective.
John, thanks so much. John Bilton there from JP Morgan Asset Management stays with us. Now, coming up, at an impasse as a deadline to reach a deal approaches, Democrats and the White House are still far apart on U.S. stimulus plans. We'll discuss the world's biggest economy next. This is Bloomberg.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's talk about the U.S. and Democrats are pressing for more concessions on pandemic relief. That's ahead of an end-of-the-week deadline to reach a deal. But one of the White House's chief negotiators has warned there is little time to negotiate. Well, still with us, John Bilton from JP Morgan Asset Management. John, what are you expecting from this aid package? How big does it have to be meaningful? Or do you just want something for the symbolism of it?
Well, I think there's a lot of expectation around it. Of that, there's no doubt. I mean, we do expect a reasonable-sized commitment there does, for all we're seeing a lot of the politicking going on at the moment, and we're hearing a lot about the disagreements. At the end of the day, if you pare it down, it's not a question of direction. Both sides of the aisle appear to be wanting something done here. The question's over the magnitude, and it's not as if we've got a huge difference. Probably the biggest difference being on the state and local funding, where there seems to be a wider gap. But things like the continued unemployment support, etc., it doesn't appear the numbers are actually that far apart. So we remain somewhat optimistic that we will get some kind of a package. I mean, but let's be absolutely clear. Already, what we're seeing is a significant amount of stimulus, an unprecedented amount, one would argue, that the US has already released. The announced stuff is over 10% of GDP. In headline terms, probably even more than that. And the packages being talked about could be 5, 6, 7% of GDP in terms of their scale. So it is significant. And I think that's one of the reasons why the market remains optimistic. And also, I think that we have a situation where it is not necessarily in anyone's political interest for something not to go through. So while I'm sure we'll continue to see horse trading, and we could get a little bit of nerves as we approach some kind of deal or deadline, we are optimistic that something will come through.
John, would you be buying gold right now? What's supporting gold?
I think, central bank policy. I mean, let's look at it. Let's look at it very clearly. And I said this, I think, to you before, Francine. When you look at gold, one thing you can be certain about gold is it will give you nothing. And if you look at what the short end of the curves will give you in any major currency, indeed the entire yield curve in many major currencies, in real terms, it's giving you negative. So relatively, gold looks pretty good on that basis. And remember, it's a finite resource, it's a finite asset. Nobody's making any more of it, and as a result, it tends to respond in price terms. And we are at the moment, I think, seeing a combination of uncertainty and significant negative real rates around the globe, fueling ongoing desire to hold gold, both as a safe haven, but also as a near cash alternative. So I think that the move that we're seeing in gold certainly looks as if it will have some momentum to it. And until we can really see an end to this period of negative real rates, which is likely to be some time hence, then I think that we're going to be in a situation where gold continues to have something of a shine for investors.
John, thank you so much. Speaking to us today, there, John Bilton, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. Now, coming up, I'll be speaking to the Bank of England Governor, Andrew Bailey. You can catch that interview from 1 p.m. London time. So I'm off to the Bank of England next, but Nerichevich will be joining the show shortly. This is Bloomberg.
Bloomberg Surveillance, I'm Naira Chehich in London. Francie Larquhar is off to the Bank of England to speak to Governor Andrew Bailey. You can catch that interview at 1 p.m. Now let's get the Bloomberg Business Flash with Laura Wright. Hi, Laura.
Hi, Naira. ING has seen provisions for bad loans surge, the Dutch lender putting aside over 1.3 billion euros to cover the expected defaults. Net income at the bank slumped 79%. It's a similar story across much of the industry, with banks being hit by the unprecedented impact of the coronavirus. Lufthansa is toughening its tone on job cuts. The carrier says compulsory dismissals are likely in Germany. The goal is to slash headcount by about 22,000. Europe's biggest airline posted a loss for the quarter, wrapping up a dismal set of results for the sector. TikTok is setting up its first data center in Europe with a 420 million euro investment in Ireland. It's promising to create hundreds of jobs and improve the safeguarding of user data. It comes as the video app finds itself in the center of tensions between Washington and Beijing. The company is looking at ways to distance its international and domestic Chinese operations in order to appease regulators. Samsung has set out its premium Android device lineup for the rest of the year. It's launching the Galaxy Note 20 series, but it's not just the smartphone. It's echoing Apple by focusing on an ecosystem for its products, including a smartwatch and wireless earbuds. Samsung lost the crown of the world's biggest smartphone maker in the second quarter, and it's hoping the new products reignite interest. That's the Bloomberg Business Flash. Naira.
Laura, thank you so much. Now let's take a look at some of the other stocks on the move this morning in what's been a busy day for European earnings. Here's Danny Berger. Hey, Danny, what are you watching?
Hey, Nair, yeah, their earnings don't stop. One of the big movers, in fact, the biggest mover to the upside if you take into account market cap for the stock 600, is Siemens. A really strong show here, profit rising by 8%, handling the virus and the pandemic much better than expected. Really, that's in thanks to some of its Chinese sector recovery, as well as what Jefferies calls a very strong showing in their software development. Now, if you want to look at the second biggest mover by market cap, that's going to be Adidas, helped really here by an e-commerce boom. Sales there doubled from last year, and compensating really for some of the pandemic-related store closures. And when people were going to stores, Adidas found that they were buying more frequently, so their shares up 3.5%. Morgan Stanley did call the earnings a mixed bag because sales may have done better than expected, but overall earnings did disappoint. But they said expectations were so low from the buy side, so that's really aiding here. Now, finally, one of the big movers to the downside is Glencore, on track for its biggest drop in about 2 months, down by more than 3.5%. The big story here is they've scrapped their 2020 dividend. They had put it on pause earlier in the year, but remember, a lot of people hold this stock as an income play, so this is surely going to dissuade a lot of those types of investors. Now, it did pour money into its trading business, capturing some of the volatility in the commodity space there, holding oil, storing oil when we saw prices crater. One of the things, though, this did cause them to rack up some debt, but that trading, like we saw at BP, for example, certainly aiding Glencore in the quarter. Naira?
Danny Berger, thank you so much. And yeah, Glencore's been leading losses in the FTSE 100. ITV's also slumped after saying it wouldn't provide an outlook for the rest of the year. So the FTSE 100's not been doing too well in this session. But overall, you're also seeing European equities in the red. We did recoup losses for a little while earlier, but we're back down by 0.25 percentage point on Europe's equity benchmark after gaining yesterday. Of course, the S&P 500 yesterday was within 60 points of its February record. Could we get there today? Futures not giving us a whole lot of direction right now. Gold still beyond 2,000 for a third day, up 0.4%, $2,046 an ounce. You're seeing some broad dollar weakness. It's steadied up a little bit, but it's near a 2-year low. And the pound, one of the best performers following the BOE decision, 131.50 on cable. Coming up, we'll get more from our interview with Dr. Anthony Fauci, director of the National Institute of Allergy and Infectious Diseases. That's next. This is Bloomberg.
another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance and politics. This is Bloomberg Surveillance. I'm Naira Chahich in London. Let's get the Bloomberg First Word News now with Laura Wright. Hi, Laura.
Thanks, Naira. The Bank of England is not ready to follow its peers into the realm of negative interest rates. It's opted to keep the benchmark at 0.1% and left asset purchases unchanged. The central bank says it does not plan to tighten policy until there is significant progress in achieving the 2% inflation target. It also doesn't expect the UK economy to reach its pre-COVID level until the end of 2021. US efforts to crack down on Chinese technology look to be extending well beyond TikTok. Secretary of State Michael Pompeo is urging American companies to block Chinese applications from their app stores. This so-called clean network guidance is not binding, but it is an escalation in US efforts to curb the influence of Chinese technology.
We want to see untrusted Chinese apps removed from US app stores. President Trump has mentioned impending action on TikTok, and for good reason. With parent companies based in China, apps like TikTok, WeChat, and others are significant threats to personal data of American citizens, not to mention tools for CCP content censorship.
Democrats are pressing for more concessions on pandemic relief. That's ahead of the end of the week deadline to reach a deal, but one of the White House's chief negotiators has warned there is little time left to negotiate. Chief of Staff Mark Meadows says the administration has given more ground than the Democrats. President Donald Trump wants an earlier debate with challenger Joe Biden. They've got 3 presidential debates planned already, but the Trump campaign is calling for one to be moved forward or a 4th added. They're hoping for a clash between the 2 candidates before early mail-in voting starts in September. And the chemicals suspected of causing that deadly explosion in Beirut had been lying in storage there for 6 years. That's according to documents seen by Bloomberg, and despite warnings from customs officials about the hazards. Ammonium nitrate can be used to make fertilizers and explosives, and the amount in the building was said to be the equivalent of about 1,800 tons of TNT. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Naira.
Laura, thank you so much. Just got some news on Barclays crossing the Bloomberg right now. So Sherborne Investors Edward Bramson has made a comment in a letter this week. This has been seen by Bloomberg News, and basically what we've learned is that the activist investor is boosting his stake, also keeping pressure on the trading rejig. So despite a strong first half of the year for Barclays, it hasn't really stopped the top shareholder from renewing calls to shrink the lender's investment bank. We'll bring you more details a little later in the program. But right now, let's get back to coronavirus. And the race for a coronavirus vaccine continues. In the meantime, there's division in the US over the political handling of the pandemic. Dr. Anthony Fauci spoke exclusively to Bloomberg's David Weston yesterday about this very topic.
When you talk about the situation we're in now, we're in the middle of a pandemic, and we have other considerations that have to do with economic and political and other things. I have nothing to do with that. If you're talking about a medical question, listen to the medical experts. That's the advice. And you will not get a conflicting message from the medical experts about things like hydroxychloroquine, about what the results of a vaccine trial are, or what the results of monoclonal antibodies. So when it comes to pure public health medical things, listen to what the medical experts say.
How is President Trump getting his medical information as a practical matter? Because there seems to be some conflict on things like hydroxychloroquine, and not limited to that. Is there a vetting of the information that he has access to?
You know, I don't know that because I certainly don't have privy to all of the input into the president. The only thing that I know is what we do, and we do that through the task force, through the vice president. The vice president then briefs the president, or, like we saw yesterday, the president invited us all to the Oval Office to brief him in person.
So Dr. Fauci, let's look into your crystal ball right now, and assuming we don't have an fully effective vaccine in the next 18 to 24 months, what does a trading floor on Wall Street look like? What does a school look like? What does a public event look like?
You know, I got to tell you, David, I believe, and I sound like a broken record, which is good, because I want to sound like a broken record. And that is, there are things that we can do without shutting down the country that can get those numbers down to a manageable amount, that you could do things that would be very productive and enhancing of the economy. We should not think of either lockdown completely or caution to the wind. There's a middle ground that we can do of the 5 or 6 things that I mentioned to you that will allow us to prudently and carefully open up the economy. It's not all or none. I think there's a misperception that unless we either lock down or open up, there's nothing in between. There is something in between. The issue is, and I want to give this a point because I really am going to, over the next days to weeks, keep repeating it over and over again. We got to make sure that all the links in the chain of the United States of America as a country, bringing that virus down to a level that we can function, where we don't have to lock down, where we can revitalize the economy. We can do it, but all the links have got to work. You know, I use, you know, I'm trying to use analogies or metaphors that people understand. You could have a lot of people, a lot of states doing really well. When you have segments of the population that don't appreciate that even though they may not get sick from the virus, if they are careless and allow themselves to get infected, they're propagating the outbreak so it doesn't go away. And that kind of obviates all the good things that other people are doing to stay safe. I use the analogy only because I learned this from my daughter. My daughter, when she was in college, was on the varsity of a Division I crew team in college. And I used to go to those matches. And you're an 8-person boat. The only way you win the race when every rower on that boat is doing it correctly. You get one rower on the boat that either accidentally, as they say, catch a crab and go off, or not doing it enough, the boat doesn't win. So it's the same thing. We're all in this together. Unless we all do it and do it correctly, we can get it down to the point where we can open.
That was Dr. Anthony Fauci speaking to David Westin. Now coming up, king of spin-off Siemens gets a boost from its software unit as adjusted earnings climb 8% for the quarter. We'll hear from CEO Joe Kaiser shortly about results and plans to list more parts of the business. That's next. This is Bloomberg. This is Bloomberg Surveillance. I'm Naira Chahij in London. Let's get the Bloomberg Business Flash with Laura Wright. Hi, Laura.
Thanks, Naira. Nintendo has posted a soaring profit helped by the popularity of Switch sales and hit game Animal Crossing. That's despite the console being hard to find for most of the year due to supply and shipping issues. But sources have told Bloomberg the gaming giant is raising its production target for the Switch to around 25 million units. Samsung has set out its premium Android device lineup for the rest of the year. It's launching the Galaxy Note 20 series, but it's not just the smartphone. It's echoing Apple by focusing on an ecosystem for its products, including a smartwatch and wireless earbuds. Samsung lost the crown of the world's biggest smartphone maker in the second quarter, and it's hoping the new products reignite interest. That's your Bloomberg Business Flash. Naira.
Thanks so much, Laura. Now, a strong first half of the year for Barclays traders hasn't stopped its top shareholder from renewing calls to shrink the lender's investment bank. In a letter seen by Bloomberg, Edward Bramson's Sherborne Investors says that Barclays should mimic cutbacks at Deutsche Bank's trading operations to improve profitability. Sherborne recently boosted its stake to almost 6%. Joining us with more details from Bari in Italy is Bloomberg's Stefania Spezzati. Congratulations on the scoop, Stefania. Great job. So what did you learn from this letter that Bloomberg News managed to get a hold of?
Hi, thank you so much. Yes, so it was basically after a quiet period from Bramson. He's back basically, and by increasing his stake into Barclays, even if by just a marginal amount, he's showing his commitment to stay here for the long run. So he's proposing that basically Barclays goes down the Deutsche Bank route in restructuring, so in going ahead with a massive restructuring of basically the corporate investment bank to improve the profitability and to lower cost and to optimize the capital.
Yeah, the thing is, though, in the latest set of earnings, Stefania, the investment bank actually beat estimates. So are these criticisms justified right now? I know they're long-standing criticisms from Edward Bramson, but nonetheless, the last set of results maybe puts a question over that.
Yes, absolutely. I mean, obviously, Staley's strategy has been working during those 2 quarters. They have been benefiting from, very high volatility in the markets. However, the activist is making the point. However, the activist is making the point that this is just a short-term, those are short-term gains, and that you can really base the strategy of the entire lender over just a couple of good quarters of trading that are actually happening in very extraordinary circumstances, considering obviously the pandemic and the extraordinary market circumstances that we have seen. So he's basically keeping his point that Barclays should really have a big look at his strategy, and he should really restructure the whole unit, security unit. He's also asking, basically for the first time, we actually have an idea of the size of the restructuring that he's suggesting to, which is very similar to what Deutsche Bank has been doing. So it's basically suggesting that Barclays should consider a 24% reduction of the corporate investment bank assets, which is quite a lot.
Just briefly, Stefania, do we have any response from Barclays yet? Do you think we'll get one?
Barclays is declined to comment for now. So this is the latest from them. They generally in the past they have never been commenting those kind of letters from the activist. We also have to guess that probably they haven't met recently, considering the travel restrictions. So we're not obviously operating in normal a normal environment.
We'll let you get back to work in Bari. Thank you so much, Bloomberg's Stefania Spezzati with a Bloomberg scoop. Now let's get back to earnings stories. Siemens' operating profit rose in the quarter as Europe's largest engineering company dealt with the coronavirus crisis better than expected. Since taking the helm in 2013, CEO Joe Kaeser has dismantled large parts of what was once one of Europe's largest conglomerates through IPOs, spin-offs and sales. We spoke to Joe Kaeser earlier this morning and started by asking about the Flender spin-off.
We have decided that we are planning to spin off Flender, which is a very reputable company with its own strong brand. This is going to going to be presented at the AGM in 2021 for shareholder approval. We believe it's the right thing to do. We also always want to obviously include our shareholders in the value creation, which we believe has been tremendous also at Flender, and that's the plan.
Good morning. Thanks so much for joining us. Can you just dive a little bit deeper into that? You're going to announce this. What's the evaluation of it? And would you consider a cash bid from private equity? Just give us a little bit more details.
Well, with regard to Flender, you know, we basically restructured the company. It's well underway now. It takes good growth rates in very attractive growth markets, such as renewable energy. It's one of the world market leaders in gears. So it's a very strong company, and we have a plan. And our plan is that we are going to return the proceeds to shareholders via spin-off. We want to have that approved at our AGM 21, and whoever believes that they've got a better idea for the customers, the employees, and the shareholders, be happy to listen.
Joe, you are on your way out, and there have been reports that Roland Bush is going to take your job as CEO in October rather than in February, as previously had been planned. Can you also confirm that this transition is going to happen sooner at Siemens?
Well, we've always made it clear that we do want to have a very smooth, long-term oriented transition. So Roland Bush will take over the responsibility for fiscal 2021 already in October 1st. I think that's only logical, because then he's got the responsibility and the accountability for a whole fiscal year. That's been a long-term plan, which we actually have been announcing already sort of 6 months ago. We've made a very long succession plan. He's the right guy. He's really, really strong, good manager. So I'm very happy to see that he's taking the responsibilities and bring the company to the next level. We believe we have prepared the company well for the next level in doing what we had to do. And now, you know, there's a new generation, which we announced yesterday, also with new people on the managing board. And I'm very happy what I see.
That was Siemens CEO Joe Kaeser. And coming up, Novo Nordisk raises its forecast as demand for its diabetes drugs weathers the pandemic. We'll speak with CEO Lars Frøgaard Jørgensen next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance and politics. This is Bloomberg Surveillance. I'm Naira Chehich in London. Now, Novo Nordisk has raised its forecast for the year as demand for diabetes and obesity medicines weathers disruptions from the coronavirus crisis. The Danish company, the world's biggest insulin manufacturer, says operating profit will rise between 2 and 5% in 2020. Sales are set to grow between 3 and 6%. Joining us now is Lars Fruergaard Jørgensen, CEO of Novo Nordisk. Lars, great to have you on the show. Thank you so much for joining us. It's interesting what we've learned from your earnings on the diabetes medicines. You've pointed out to me that people do still need to get treatment even if there's a pandemic going on, but there has been perhaps some signs that people have shied away from hospitals during the pandemic, being scared of getting infections. So perhaps you could say that new diabetes patients are not getting diagnosed. Does that mean that there's any potential risks to this trend for you in your diabetes medicine?
You're right that we have seen in the first half of the year. First, there was a hoarding, so patients picked up more medicines to protect themselves, as these are life-saving medicines for people living with diabetes. And then as we saw countries closing down, there were less patients visiting the physician to get on new treatment, more efficacious treatment. And that impacted our growth in the second quarter, both a reversal of inventories, but less new patients. We can see from the script data that we were down some 30-40% across some of the brands, but that's now picking up, so around 50% back to normal level. So when you have diabetes, you need efficacious treatment, and if you're no longer in good control, you need to be on a better medicine. So we see that patients are now flowing back into the physician offices again.
Oh, right, that's interesting. And when do you expect it to actually return to normal, pre-pandemic normal?
In our guidance, we have assumed that we'll be back to a normal level throughout the second half of the year. Obviously, that relies on how COVID-19 pandemic plays out in the different geographies. But it's interesting to observe that I think as a society, we're learning to operate together with a pandemic like COVID-19 coexisting. And so I think we'll see second waves here and there, but I don't think we'll see complete lockdowns that will mean that we go back to where we were, say, in March, April. So we expect a gradual normalization throughout the second half of the year.
Okay. Let me ask as well about ongoing pricing challenges, especially in the US. You've said it expects the pressure to continue. For how much longer, and how will that impact your business?
We see, if you look at the total insulin market in the US for the first 6 months, it was down the value of the market by 11%. And that's a continuation of a trend we've seen for quite some time. And we also see that there's pressure on pricing because there are a number of products that the payers are playing out against each other. In addition, we see US unemployment, meaning that a number of people living with diabetes and other serious chronic diseases have less and less insurance coverage, which means that they get on plans that have a lower price point, and we also have affordability options to help patients. So I think we'll see a continuation of price pressure in the US in this market structure. It's very important to note that we are actually converting our business from being an insulin business to being a GLP-1 based business. The segment where we have the toughest price pressure in the US is actually becoming very, very small, and now our growth is fueled by GLP-1 products.
Okay, so you mentioned growth there. Let's talk a little bit about costs. What savings have you been making? What cost cuts have you been doing?
Our increased guidance on operating profit is linked to cost savings, and obviously we have saved a lot of money on not traveling around the world conducting our business. We have also saved some money on the promotional efforts as reps were locked up back home. They could not be in the field. We could not run conferences like we normally do, and we also had a slower burn in R&D. So we estimate that approximately 1 billion Danish kroner has been saved this first half year because of COVID-19. Some of that will be shifted into second half, but we are raising our operating profit guidance growth to this 2 to 5% from 1 to 5 because of these savings.
Okay, 1 billion Danish kroner saved because of COVID. That's interesting. Just briefly and finally, Lars, how much has it cost you to stockpile for Brexit?
Well, it's not a number we kind of worry that much about because we committed to the patients. So we have made sure that there is enough products in the US to hopefully get us through a difficult period of time here. But it is important that policymakers come together and sort out how this should be handled.
Okay, Lars Fruergaard Jørgensen, we appreciate your time, the CEO of Novo Nordisk. Thank you so much for joining us today. And Bloomberg Surveillance continues in the next hour. Don't miss Francie's interview with the Bank of England Governor Andrew Bailey at 1 p.m. London time. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
This morning, the Bank of England, it studies the experiment known as negative interest rates. It calls the experiment, quote, less effective. Chairman Powell will watch carefully. Governor Bailey, he will speak with our Francine Lacroix. Look at that in the American 8 o'clock hour. The ADP report, well, it was flat out not good. Claims this morning are more important. In Jobs Day on Friday, the president looks for a, quote, big report. And the doctor is very in on the pandemic. His message is clear. Dr. Fauci says, listen to the medical experts. Good morning, everyone. Bloomberg Surveillance from New York, from a very Bank of England-y London, Naira Chayachin for Francine Lacroix as she performs interview with Governor Bailey. And Naira, this is a big deal. I mean, this is original monetary economics for the bank.
It's a huge deal, and we've actually got some headlines coming out right now from Andrew Bailey. The red headline is that he's saying that negative rates are in the toolbox, but there are no plans to use them. Now, since the decision, we did actually see the market pare back a little bit its pricing around negative rates. Bailey also saying that the Bank of England's forecasts have an unusually large downside skew. Now, the reaction in the pound suggests that the market took the BOE's forecast as pretty robust. You can see it higher there intraday, 131.72. Bailey also saying it's hard to draw a conclusion from the Bank of England's forecasts, and we must be careful not to overinterpret faster indicators. So he's speaking in a briefing to journalists right now, saying the BOE could use other tools too, like forward guidance. Negative rates are in the toolbox, but we have no plans to use them, Tom.
Managing the message, we'll get to the data check here in a bit. It looks like he's moving the market with lower interest rate regimes seen across the U.S. and, of course, sterling on a tear, 131.69. Look for our conversation with the governor of the Bank of England, Francine Lacroix, and the governor at 8 a.m. New York time. That's 1 p.m. In London. She has, I know, some very pointed questions from our economics team at Queen Victoria Street. Right now with our news in New York City, here's Ritika Gupta.
Morning, Tom. Naira. Democrats are demanding more Republican concessions for a deal on a stimulus package. Senate Democratic leader Chuck Schumer says that there has been some forward momentum, but he's calling on the White House to do more. White House Chief of Staff Mark Meadows says if the two sides can't agree, President Trump may take executive action to extend unemployment benefits and a moratorium on evictions. Twitter and Facebook blocked a video shared by accounts linked to President Trump. Both said the video violated its policies on coronavirus misinformation. In a clip from an interview, the president said that children were virtually immune from the coronavirus. And Secretary of State Mike Pompeo is signaling that U.S. efforts to banish Chinese technology will extend beyond TikTok. Pompeo urges American companies to bar Chinese applications from their app stores. He says apps like TikTok and WeChat pose significant threats to Americans' personal data. There are fears of a food shortage in Lebanon. That massive explosion in Beirut destroyed major grain silos, creating a crisis in a country that imports nearly all of its food. And it comes at a time when Lebanon is suffering its worst economic crisis in decades. The government is trying to get a bailout from the International Monetary Fund. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities, futures. Green on the screen here is what we see right now. And with it, the negative rate regime, it continues. There's no other way to put it. We've seen yields break down here off those Bank of England headlines. 2-year yield pretty static, actually. 10-year yield not near record low, but getting there, 0.5330. We go to 4 digits here on Bloomberg Surveillance. We like to go to 4 digits in our data check. 30-year bond 1.2018 as well. And I'm really looking at the 10-year tips. This is the stunning real rate statistic of a negative 1.0837. Naira, that's an extraordinary statistic. Naira, we go to 4 digits here on Bloomberg Surveillance.
Yeah, it really is. And of course, it's those real rates that have largely been pushing gold higher on gold. We're above 2,000 for a third session. You see a little bit of risk off in European equities, a lot of earnings to digest. The dollar near a two-year low, but making a little bit of a comeback. And of course, the pound very much in focus, one of the best G10 performers, up 0.4%. Bailey just saying just now to journalists that negative rates are in the toolbox, but they've no plans to use them. That pricing has come back in the market on negative rates. And also the market took some of the guidance from the BOE as well, it seems, as slightly hawkish. Joining us is Jeffrey Yu, BNY Mellon Senior Strategist for EMEA Markets. Jeff, great to have you with us. So let's kick off with the negative rate debate, and why not start with the Bank of England, as we've just had those comments come through from Andrew Bailey. Are we going to see negative rates at all in 2021? The market has repriced a little bit off this morning's news conference.
Short term, I don't think so. If you look at the monetary policy report, there's an interesting Q&A session, a FAQ bit, where they basically say there's a chance where the volume of lending could actually be restricted with negative rates if lenders are concerned about future capital ratios. And then they say the banks in the UK are resilient, but they could be worried about future capital ratios due to loan losses from COVID. So that's them all kind of hedging themselves, but explaining, yes, they can do negative rates, but it's not effective under the current environment. Better not try it. Think about something else, such as yield curve control.
Jeff Yu, I give Antonis Orphanides, the former Cyprus Central Bank governor and, of course, an ace head of research at the Federal Reserve. I give Orphanides the great credit for the focus on the toolbox. But a toolbox is based on its ability to change things, which we call degrees of freedom. How limited are the degrees of freedom in the Bank of England and at the Fed to avoid negative interest rates?
Well, they are extremely limited right now by virtue of you have an economy, that could just shut down. Output can go from 110% to 50% within 2 days or 3 days, by government orders. So those are things that central banks, cannot push back against. And again, if those economic shocks lead to loan losses, then no matter what's in your toolbox, the banks are not going to buy it. The banks are just going to stand pat and hoard cash and conserve capital. So again, they will start to pass things back to governments and fiscal.
Let's do a history lesson, Jeff Yu. When Europe instituted negative interest rates, did they overtly do it, or were they forced to do it to follow the market?
So the market was pushing them in that direction. From that point of view, they overtly or out of their own volition, because they genuinely believed that it would have a stimulus effect. They found the right point in the cycle, where banks needed incentives to actually start expanding their balance sheets to give out loans. Right now, it's completely different, because we can have a cycle, but then we can have a cycle that's going to be suddenly caught short. That's the difference, and I think that's why negative rates, the efficacy is limited right now. Look at Sweden. They went negative. Now they're not thinking about going negative, because in this environment, they don't think it works.
Jeff, the front end is where we're seeing the potential for negative rates being priced. But is a 10-year gilt yield at 12 basis points fully pricing lower for longer from the Bank of England? I know that stimulus has something to do with the pricing in the 10-year as well, but what is the dynamic right now in that 10-year? I've had somebody tell me this morning we could get to zero on the 10-year gilt yield.
So that, I think, right now is more on balance, pricing in some degree of yield curve control. So if the UK is going to go there next, are they going to go to Japan, where you just target zero, all the way out to 10 years or even beyond? Or is it Australia, 25 basis points at the 3-year point? There's really no hard answer to this right now. But as far as the markets are concerned, better safer than sorry, you price it out longer end of the curve. And also, given gilt market's maturity profile, it's like double the G7 average, then you have a lower term premium anyway. So it would be understandable if the 10-year for the UK is trading lower than elsewhere. But for now, it's certainly pricing in stronger policy.
What does all that mean for sterling?
Sterling, I think you have to look at a cable story and a euro sterling story differently. Euro sterling, we actually would favour the euro story a lot more, given they are getting their act together. NGEU planned a lot of investment coming through, doing the right thing finally. Whereas cable, I think cable upside is more of a dollar weakness story. The dollar longs, and not just in dollars, but in US equities and US tech, all of that money. So it's not being liquidated per se, given how US is performing, but hedges are being put on. But if the US gets fiscal through, then sterling could have a bit of a correction here.
Jeff, I've got to rip up the script here. And again, folks, Francine Lacroix with Andrew Bailey. Look for that in the 8 o'clock hour U.S. time, 1 p.m. London time. Jeff, I've got to rip up the script now and go to something that your colleague in crime, Kit Jukes at SocGen, wrote about this morning, which is this dichotomy between developed big nation currency dynamics in what we're beginning to see in EM, which clearly on an idiosyncratic basis looks like an unraveling. Are we there now for the great unraveling in EM?
Well, EM, again, be very, very selective, So look at Thailand, Bank of Thailand, yesterday, their decision, sure, they didn't do much, but very concerned about the strength of the currency. There's close to zero tourism going into Thailand right now. We know how important that is to the economy, yet markets want to buy. Look at Korean won, for example, a bit of a choppy outlook for the tech sector up ahead. Is there going to be enough investment? But still, markets, looking to actually go long it again. But what we're seeing in our flow data, there's no bids for underlying EM assets. But currencies are being bought. Again, that tells me it's dollar longs being taken off. It's people hedging against dollars rather than going long EM. Then you have situations like Turkey, for example, where balance of payments, that's EM 101, bad balance of payments, you go short the currency.
Okay. Well, really well said, folks. And this is why we like to have Mr. Yu on. I mean, you look at Thai baht and the Bloomberg. We're not going to do that right now. But if you look at dollar baht, it's real simple. You've got some nice Thai baht strength here over the recent weeks, really out to test new strength in Thai baht in a moment. That's polar opposite, Jeff, of what we're seeing in Turkey. And there's a few other joys out there, the Argentina workout, the Ecuador workout as well. What should we take away from the new bout of lira weakness this morning?
Right, so it just tells you no matter what yields are doing, no matter where the entire developed world can go negative, deeply negative, but that is no compensation for healthy fundamentals and balance of payments. And if you add on the COVID risks, the growth risks, it's just telling you markets are extremely selective about places where they see strength. Thailand's got reserves; they're not burning through reserves. Even like Russia, I know the ruble's been a bit under the pressure, but again, better balance of payments, good reserve coverage. Those are the places which will attract inflows despite a soft economy. If there's lack, of inflows, if there's lack of a balance of payments confidence, then markets are not going to buy that. And a lot of EMs are in the opposite camp. So you've really got to choose your asset allocation carefully at this point. But EM, especially in Asia, I think on balance, markets are actually looking to go overweight again.
Jeff Yu of BNY Mellon stays with us. And later we hear from Bank of England Governor Andrew Bailey. That's at 8 a.m. New York, 1 p.m. in London. Don't miss it. This is Bloomberg.
true diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Two weeks in a row, an extraordinary week here at Bloomberg Surveillance. Nehra Chayachin for Francine Lacroix. She is in conversation now with the governor of the Bank of England. You will hear that and see that at 8 a.m. on our simulcast. Looking forward to that. There's a lot going on at BOE, particularly this discussion of negative rates. As well, we've got the labor economy of America front and center off that difficult report yesterday. The ADP report claims at 8:30, about 25 minutes after our conversation with the governor, and then on to Jobs Day tomorrow. Right now, Jeffrey, you with us as we look at the correlations in the litmus paper of the global system. Jeff, I really, with great respect to your sense of history, what does it signal to see the lower rate regime that we see worldwide?
So if you're glass half full, then basically the low rate regime is a comprehensive attempt to reflate or to overheat the economies. So this is almost last chance saloon, just to get the economies. And the next phase is an average inflation targeting 4%, 5% CPI, who cares, as long as we reflate, right? Your glass half empty, very simple. Everyone's going the way of Japan, 20, 30 years of low rates, negative rates, QE, and nothing happens. And we just might as well give up. But at this point, I'm still in the camp. Let's get to escape velocity. Let's reflate as much as we can.
I look, Jeff, at all that's going on in the glass half full, glass half empty, and many people would just say it's a bet on a sustained decline in aggregate demand. The economists at BNY Mellon still look for a difficult recovery that doesn't get us back to that pre-pandemic level vector.
Well, so at this point, going back to my point about the UK, at least for unemployment, it probably will take 2 to 3 years, and so there will be an aggregate demand displacement. How do you fill it, right? Do governments, want to fill it? And right now in the UK, it doesn't sound like Mr. Sunak does. In the US, still deciding on the picture. Europe, completely different story. Willing to invest, willing to use fiscal, willing to use low borrowing costs. This is, why we're more favourable on the euro at this point. And let's see where the divergence is. But asset allocation will favour the places where they generate aggregate demand.
Jeff, in this low rate and negative rate regime, there are some strategists out there who are saying that now is the time to underweight the S&P 500 in favor of gold. The two have been positively correlated since March. Would you agree with that, or would you say hold the S&P 500 and hold gold, or does it depend on whether you are glass half full or empty, as you were just referring to?
So if you are glass half full, I think in terms of asset allocation, equities will certainly be the best play over the medium to longer term. Equities, especially those with pricing power, they will react to investment. You will get margin expansion. You will get re-rating. Whereas gold, liquidity issues, and you have a more constrained, breadth of investability. So yes, it can always be a hedge as part of asset allocation, even a tail hedge against inflation risk. But who said that equities can't hedge against inflation? Over the longer term, they probably are a much better play there. But again, if it's an aggregate demand story, then equities will have to react to that. Gold right now, it's pure inflation story. You can't really price in aggregate demand into gold, whereas in equities you can.
Right, on inflation then, Jeff, do we have much further to run to the upside on US inflation expectations? Because that, of course, does impact how much further the real yield can fall.
Sure, plenty. So looking at the five-year forward break even, that's probably the first chart we should all look at, when we turn on our Bloombergs every day. We're at 170 right now, much better compared to a few months ago, but plenty of ways to go. If you believe the Fed wants to overshoot inflation, then we're talking well above 250, that kind of range. Remember when Draghi said he was worried about European inflation expectations being de-anchored, the inflation talk was around 170, that kind of a level. So below that, that, it's de-anchoring. So 170 is your minimum to get an overshoot. Then we're talking at least 50 basis points higher.
Jeff Yu, thank you so much. With BNY Mellon and here with futures up on a mixed equity tape, but really everyone looking at the bond market where yields come in decisively. The 30-year U.S. bond now ready to go back under 1.20%. That's a headline item. I do want to point out the unraveling of Turkey. We're really beginning to see dollar, lira get weaker, and I'm watching euro lira. I'm actually sitting here with a Bloomberg triangulating out where 4 standard deviation move is. I'm not there yet, folks, but euro Turkey is really not all that good as well. Coming up later, Marilyn Watson of BlackRock. That'll be one of our themes here of a lower rate regime. And again, Governor Bailey in the 8 o'clock hour with Marilyn Watson. This is Bloomberg. Good morning.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and business is depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg Business Flash. Toyota posted a surprise operating profit instead of an anticipated loss, and the Japanese automaker kept its outlook for the full year intact. That suggests it sees a recovery after the coronavirus pandemic hammered global car sales. Toyota's revenue in the latest quarter fell 40%. The largest engineering company in Europe dealt with the pandemic better than expected. Siemens' profit rose 8% in the fiscal third quarter. A big jump in earnings at its software business offset declines in other areas. Sales fell a less than expected 5%. And the parent of Quicken Loans and Rocket Mortgage raised $1.8 billion in a scaled-down IPO. That fell far short of the $3.3 billion that Rocket Companies has aimed for earlier. Investors pushed back on the company's valuation, and they believe that Rocket should be priced as a consumer or financial company rather than as a technology business. Rocket is controlled by billionaire Dan Gilbert. And that's your Bloomberg Business Flash. Tom Francine.
Ritika, thanks so much. I really want to say the data right now is more than interesting. Green on the screen, but that's not the story. Yields come in. There's no question about it. The 10-year yield is just moments ago broken down to 0.5313. 30-year bond at a 1.2012. Notice we do 4 digits here on our data checks, 4 digits on our bond data checks at Bloomberg Surveillance. Yen 105.61. I really want to note, Francine, Turkish lira flat out unravels this morning.
Yeah, I'm glad you were looking at lira, Tom. What also I'm looking at, so I've just come back from Bank of England where we interviewed the Bank of England governor, Mr. Andrew Bailey, and the pound is actually rising against the euro after the Bank of England said it didn't plan to tighten policy until the inflation outlook was more clear. So we'll have a full conversation, Tom, and actually some of their forecasts and what they mean for markets. European stocks are actually sliding on earnings. I know you mentioned U.S. futures. I think a lot of the focus will be on the jobs data and, of course, on the latest American stimulus package. And then gold pushing once again further above $2,000 an ounce. It's a third straight day, Tom. That's before news on whether the U.S. will approve this, trillion-dollar aid package to counter the coronavirus. So look at gold. That's what we will be doing in the next hour. Later, we also hear from the Bank of England governor, as I was saying. That interview will be at 1 p.m. in London. That's 8 a.m. in New York. We talked about negative rates. We talked about forecasts. We, of course, talk about COVID-19 and what central banks can do. This is Bloomberg.
All the lodge facilities and on all tourist facilities within the Mara, both in and out, they have all closed down. And we get much of our revenue from the park entry fees and other sources like the balloon safaris, balloon tariffs, even from the lodge rents, and all that has gone down. The surrounding community, when they are desperate, then they can do anything to hunt And we have been getting such kind of cases of bushmeat, especially bushmeat trade. And we have arrested quite a number. So far, we cannot say for commercial poaching, no, it's only for bushmeat trade. And they kill just because they are desperate to get meat.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Tom, we talked about TikTok. Let's talk about it again. With Microsoft poised to make a deal to acquire TikTok in the coming weeks, Facebook has launched its answer to the popular app Instagram Reels. Now, Facebook has a long record of adopting features that have proven popular on rival platforms. Well, joining us now to talk about all of this is David Kirkpatrick. He's Techonomy Media founder and chief executive officer, and of course, author of The Facebook Effect. David, I haven't asked Tom Keene whether he's on Instagram Reels yet, but how much market share can they actually get from TikTok?
Well, I think they can get a lot of market share in general. They'll probably create new customers, but I think they'll also take customers away from TikTok. I think that's their intention. I think they're being very opportunistic by introducing Reels right now. But I also think we've got a lot of people who want to use these kinds of seemingly frivolous applications. So there may be room for both.
There's room for both regionally. So will it break down? Even if TikTok gets acquired by Microsoft, is it still going to be seen as a site? The Chinese social media.
Well, I don't think it'd be seen as Chinese if Microsoft bought it, and I think it's really unclear how Microsoft would handle it if they did own TikTok. But I think most TikTok users are likely to remain loyal to TikTok if they can. A number of the celebrity users have said they'll stick with TikTok until the last possible moment. On the other hand, a lot of others have been hedging their bets by telling their followers, hey, follow us over here on Instagram. I'm going to Reels. I'm going to do more on Snap, whatever. I think for many of the users of TikTok, it's extremely confusing right now to know what to do. And if your business is, making money based on TikTok or using that as a promotional system, you're really a little bit confused about what to do right now. But I think the other thing about Facebook is they do tend to release high-quality products, even though they often copy to get there initially. So I think Reels will be good, and Instagram is a huge ecosystem of its own, so it'll pull people in.
David, you are more qualified than anyone I know for the news that broke last night. The idea that Twitter is banning a video from Team Trump, his election campaign site, after Facebook did it as well. Are Facebook and Twitter under the same rules as traditional media in terms of vetting material?
No, they're not under the same rules as traditional media, because traditional media have been far more rigorous in ensuring that whatever they carry is accurate and truthful. There's still a real gray area in social media. In Facebook's case, because of Zuckerberg's obsessive belief in what he considers to be free expression, there is a very strong impulse not to regulate, not to oversee, not to take things down. Twitter, I think there's a tremendously increasing divergence between the two services, though. And I think Twitter is setting the standard for responsibility right now, and Facebook is following in their wake.
Are they, whether it's Mr. Trump or anyone else, are they impinging on their right to free speech by banning selected videos in what seems to be an arbitrary way?
Well, that's certainly what the Trump administration and what the president thinks. I don't look at it that way because I think that when you are essentially a public media, which, as you suggested at the beginning, they are, they have a responsibility to their viewers, readers, listeners, whatever you want to call them, users, to ensure that what they're seeing is socially responsible and not hugely harmful. And some kinds of expression really are harmful. And in this case, when it came to the president saying that children can't get COVID effectively, Twitter first decided that's just not acceptable. It's got to come down, and then Facebook followed. I don't think that's suppressing free speech. I think that's just simply taking concern for your users.
But will the Trump administration or will President Trump retaliate, David? And actually, can he retaliate?
I mean, to some extent, Trump would do his best to retaliate against anybody, anytime, for any reason. That's his impulse. I think he would retaliate if he could think of a good reason, but a good way to do so. But he's really dependent on these services, so he's not going to threaten to ban either one of them.
I mean, not ban, but could he try and break them up or pay? I
think that has been sort of what his impulse has been, is to be very sympathetic to calls to break them up, to move toward regulation in other areas because he's unhappy with the way they treat his account. This is very Trumpian. And certainly there's been retaliatory attitudes in the Trump administration when it comes to social media. I don't think a breakup's in prospect. And I think what we saw at the House hearing last week was that there really are good reasons why all these big social media and internet companies need to have more oversight. So, I don't really think retaliation is the issue right now.
David Kirkpatrick, thank you so much. Greatly appreciate it this morning.
Thanks,
David
Tom.
Kirkpatrick, of course, the author of The Facebook Effect, with us twice in 1 week is just too much for us. We just, we're like shaking. And I can't say enough about the book, though, seriously, folks, really quite good. The data right now is really moving. I do want to say that Turkish lira continues to unravel. Some of that is certainly due to the knock-on effect of what we see in Beirut. I'd also mention here yields coming in. The movement is so great, I've got to look at the screen here in real time. With our first read news in New York City, here's Ritika Gupta.
Thanks, Tom. Both Democrats and Republicans are looking at the clock as they try to negotiate a new stimulus package. Democrats want more concessions from the White House to meet on the end of the week deadline for a deal. White House Chief of Staff Mark Meadows warns that President Trump may take executive action if there's no agreement on extending jobless benefits and a moratorium on evictions. The Trump campaign raised a record $165 million in July. That beats the $140 million opponent Joe Biden raised. It was the first time the president has outraised his Democratic rival since April. Meanwhile, the Trump campaign has spent $82 million on TV ads so far. That's compared with $49 million for Biden. There are fears of a food shortage in Lebanon. That massive explosion in Beirut destroyed major grain silos, creating a crisis in a country that imports nearly all of its food. And it comes at a time when Lebanon is suffering its worst economic crisis in decades. The government is trying to get a bailout from the International Monetary Fund. Goldman Sachs warns that the development of a coronavirus vaccine could upend financial markets. Strategists say that the increased probability of an improved vaccine by the end of November is underpriced by equity markets. Goldman forecasts that one possibility is a sell-off in bonds and a rotation out of technology into cyclical stocks. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom Francine.
Thank you so much, Ritika. So, of course, we continue keeping an eye on what's happening in Beirut after the devastation of the explosions about 72 hours ago. And we'll talk not only about Lebanon, but also the ties that Lebanon has with France. Up next, Paul Collier, Blavatnik School of Government economist and author of Greed is Dead. We'll talk about the Bank of England. We'll talk about mortgages and, of course, the UK. This is Bloomberg.
television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance. I'm Rishika Gupta. Let's get the Bloomberg Business Flash. Nintendo is seeing a gaming boom thanks to people staying home because of the pandemic. Bloomberg's learned that the Japanese electronics company is raising its target for the Switch gaming console to around 25 million units this year. Meanwhile, Nintendo's profit in the latest quarter blew past all estimates. Lufthansa posted an adjusted loss of $2 billion in the second quarter. The coronavirus pandemic grounded virtually all of the German airline's planes. Lufthansa says it has cut more than a third of the 22,000 jobs it hopes to eliminate. It doesn't expect demand to recover to pre-crisis levels before 2024. And commodities trading giant Glencore has scrapped its annual dividend. The firm's net debt surged because it poured money into its trading business to cash in on volatile price swings. The move paid off. The trading unit earned $2 billion during the latest quarter. That's twice what it did a year earlier. And that's your Bloomberg Business Flash. Tom, Francine.
Veronica, thanks so much. Now, coronavirus cases continue to mount across the U.S., with California reporting its second deadliest day and Florida's cases count topping 500,000. Meanwhile, Chicago announced it will be keeping classes online when it returns in September. Earlier, we spoke with the National Institute of Allergy and Infectious Diseases Director, of course, Mr. Anthony Fauci.
So the way I talk about it when people ask me is that you should have a default position of what's your fundamental principle. The fundamental principle is that you should try as best as you possibly can to get the children back to school for reasons that when they're not in school, it's deleterious to the child, both psychologically and maybe even for nutrition. And then there are secondary downstream ripple effects for families that might have to stop work to take care of the children. So the goal should be to get them back. But then you have to have a but or however. And the however is fundamental to everything is the safety, the welfare, and the health of the children, of the teachers, and secondarily of the parents who may be interacting, which they obviously will, with their children. So if you look at our country, it's a big country, and you have to have flexibility because nothing is unidimensional here. You have some parts of the country where there's very little infection, and without any punity, with impunity, you could open up the schools and no problem. We call them the green states. And then there are those that have some degree of activity in which you really want to do something like you're suggesting. Maybe a hybrid, physical spacing, masks, outdoor classes, whatever you want to do to mitigate any spread. But there are other areas of the country when at any given time, and it may be just temporary, where there's so much activity in the community that you really want to think twice before you start putting kids back to school. And if you're in that zone, you probably are going to have parents who are not going to want to bring their children back, or teachers who are not going to want to show up. So when you talk about schools, David, you can't say the United States is one place. It's multiple regions.
At the same time, how do we create a sense of confidence, as you say, in teachers, in parents, in students themselves, that you need to do these things, don't cut them short, but if you do, you're reasonably safe? Because it's two messages, actually. You can't forego them, but if you do, it's probably going to be okay.
Well, that is a tough message. It is, because often when you try in a way, take a look at some examples. There have been examples of schools that have opened where, on day one, you wind up having children infected. We're going to have a policy which is still now, and first of all, I think we didn't mention one thing that's important. The CDC has put a lot of work into giving guidelines about how one can mitigate the spread of infection and the transmission of infection in schools. I think people should take a look at those guidelines.
Dr. Fauci, Larry Summers, you know him, former Treasury Secretary, economist from Harvard, has said, actually on Bloomberg, that what we're doing essentially is launching thousands of cruise ships this fall with a bunch of 19-year-olds, and he's referring to the dorms in universities. Does he have a point?
Well, if not done correctly, that you could have, because when you congregate people together. But if you look at what some of the universities are doing, who are opening, a lot of them are doing something similar in some respects to what some of the major league sports are doing, where they're testing everybody once to get there and then intermittently surveilling and then trying to determine if you do get an infection, get that person out and put them in a sequestered way. So some colleges, as you know, are going online completely. Some are doing online for certain of the years of college and in person in others. And some are doing it completely open, but we're doing a lot of testing. Again, it's not one size fits all.
Dr. Fauci with our David Weston yesterday, and of course, managing the message that experts are to be listened to in science. There is a science of economics, and there has been a set of economists in America, Jeffrey Sachs of Columbia, William Easterly of New York University, and in England, the high ground is owned by John Kay and Paul Collier. They have questioned our economics. They have questioned our certitude of economic man. Paul Collier joins us right now, professor of economics at Vavlatnik at Oxford right now. And this is such an honor, Paul, to speak with you. I can't imagine the energy of Greed is Dead written with John Kay. What do you say new here versus the primal scream of your wonderful The Bottom of Billions? What is the new in Greed is Dead?
Yeah, thanks. Thanks for having me on. We're both pretty proud of this book. We wrote it fast, and we realized we needed each other. I'm a specialist in how to build social cohesion in an organization, and John's a specialist in managing uncertainty in an organization. And we realize that these themes work together now for businesses, and that's the theme of the book. So all businesses at the moment are hit by deep uncertainties. Coronavirus is just a classic example of derailment by something where there isn't a model. The chief executive does not know best because nobody can be guided. Nobody's got the core knowledge. This is what to do. We just don't know. And that's the hallmark characteristic of radical uncertainty. We don't know.
I mean, this goes back to Peter Bernstein, his wonderful Against the Gods, folks, this definition of uncertainty with risk as well. Professor Collier, what I find fascinating here, and this comes out of your wonderful TLS article, is all the structures of everybody that watches Bloomberg surveillance are under threat. You go back to the game theory of von Neumann, you bring it forward to the wonderful Ronald Coase, and all of the doubt that's been set up by Thaler and Schiller and others. Is economic man dead? Is the certitude of our models dead with this pandemic?
Yeah, it is. It's been shown to be really dangerous because when you embrace uncertainty, it doesn't lead to despair, it leads to actions. And one of the actions is building resilience. The other is, if you don't know, you find out. And you find out by decentralizing decisions to the coalface where experiment and experience and rapid learning and adjustment to error can best be done. And so you need to devolve. But, and here's the killer, in order to be able to devolve safely, you need to be able to trust the workforce. And that's where building cohesion within the organization comes in. The whole team needs to be unified around a common purpose. And the great thing that a leader can do, the chief executive, is communicate common purpose. So we think of chief executives as not just commanders-in-chief pulling levers. You know, I know best what to do, I'll pull the levers. That's pretty dangerous when you're facing uncertainty. The role of the chief executive is to inspire all the people in the organization that we collectively have the same purpose. And then you can safely decentralize to others. So that's the core message of Greed is Dead. But yeah, it's a serious book. We go back, we unstitch all the first principles of we know the model, and we show they're wrong.
Yeah. Professor, it's a great book. Let me, though, ask you about COVID and actually the UK economy. Where will the biggest scarring come from?
So the biggest scarring will come from in the next few months when firms run out of all the government schemes, and then they have to decide what to do. And some should close. Their opportunities have been damaged permanently. Some need to be, the organization needs to be kept alive. The great asset of a modern economy is all that organizational capital that a firm represents. And that organizational capital is not in the equipment, it's in the people. And so a lot of firms are choosing to keep their staff in post, even though at the moment they've not much to do, because they don't want to destroy that hard-built organizational capital. And by showing that trust and investment in people, that will build loyalty. And so they're actually investing in loyalty. And then some firms are taking very short-term profits views, getting rid of people. They'll pay the price.
Professor, yeah, but this is all because there's government support, right? If you're a big or small business, sometimes you can't afford to keep your staff if they're not doing much. So does the current government scheme in the UK need to be extended?
I think it does. You know, the honest answer is we don't know. But it would be disastrous if we get a coordinated, forced unemployment. Some firms really do need to close, but that process of discovering which firms are permanently damaged and which firms really need to be kept alive, that's again best done by decentralizing. What we need is a lot of venture capital around Britain. We've not got enough venture capital around Britain. America's in better shape because it's more widely distributed. In Britain, nearly all the venture capital is in London. So 2/3 of all our venture capital investment is in Southeast England. But 2/3 of our businesses are outside Southeast England. So we rapidly need to decentralize venture capital.
Professor, just because of time, I've got to ask you this question. This isn't working at the polling booth. I don't think Donald Trump is going to read your book. I hate to break it to you, but I don't think the President of the United States is going to read Greed is Dead. We've got a president.
He might not like it, actually.
He might not like it. The president likes the art of the deal, the certitude of the big guy, and frankly, the prime minister maybe is not all that different. Why is democracy not going the Collier K route?
I think it will, actually. I would dispute your description of Boris Johnson. I think Boris Johnson is actually pretty pragmatic. He gained his premiership by getting a lot of votes in the north of England. And so he's got to make the recovery of the provincial economy work. You know, and he knows that he himself doesn't know, but there are sensible ways of experimenting. The acid test will be whether he devolves some power to the new regional governments that Britain's got.
What if
with President Trump, I tend to agree with you. I think he's a lost cause, as it were. He never was a hopeful cause, frankly.
Paul Collier, as we end the interview here, what is so important about Greed is Dead is the long-term impact, the shift, as James Bullard would say, the regime change in society. You write about it, Mariana Mazzucato writes about it as well. Does this have a lasting permanence? Does the shift here to something different in economics actually have legs out 10 years or 20 years?
Yeah, I think very much so. I think what we're trying to point to here is the turning of the tide. And that's the moment that I think we've captured, and it's been accelerated by coronavirus. It was the whole strategy of the top knows best was already in deep trouble after the 2008 financial crash. We've seen that from the mutinies that got Trump elected, that got Brexit. So we've seen the signs of political disturbance.
Right.
The danger is that disturbance heads us into crazy populism.
Professor, we're out of time. I'm going to have to cut you off. Paul Collier, we're out of time here as we go to break on a busy day, but you'll be hearing much more, folks, about Greed is Dead from me. This is an extraordinary, important book, whether you agree or disagree with it. Yes, I'll editorialize. The president should read it as well as the prime minister. Collier and Kay, Greed is Dead. What a great pleasure to speak to him this morning. Francine Lacroix will speak with Andrew Bailey. Look for that in the 8 o'clock hour. Markets on the move. Shahab Jalanus will join us from Credit Suisse. Stay with us. An extraordinary Thursday. This is Bloomberg.